Hello and welcome to The Inquisitive Investor. I'm your host, Parijat Garg, and in this show, we explore how the smartest investors and entrepreneurs think about business, markets, strategy, and process that help them succeed at what they do. In the last episode, we had invited Rohit Goyal of Mesh Finance to help us begin to understand the world of cryptocurrencies. For this episode, we have him back to take us for a deeper dive into the world of decentralized finance and DAOs, or decentralized autonomous organizations. Decentralized finance, or DeFi, has taken the world by storm, and there's a crazy number of projects being built in this space. But outside of the crypto enthusiasts, there is very little understanding of what it is and how it works. In this episode, I quiz Rohit about why any of this makes any sense at all, and also get to understand how this part of the crypto universe works. Hi Rohit, welcome back for the second episode of The Inquisitive Investor. You know what? Why don't you start with actually tell us what you've been busy with? I know you've been building Mesh Finance. Can you start as a good introduction to what DeFi is? Maybe you can just start a little bit with what Mesh Finance is.
Yeah, so Mesh Finance is a community which is on a mission to bring decentralized finance benefits to every human. So in today's current form, decentralized finance is limited to very few number of people because it requires high technical knowledge and high financial knowledge. So Mesh Finance community is trying to simplify it and trying to take it to the average users and like the retail users, which is what DeFi was meant to be. And the first product we are building with that is yield accounts, where you can earn better yield on your fiat currencies compared to your traditional bank account. The second product, which is right now in progress, is building an index protocol, where you can create thematic index, which at the same time can earn yield on your behalf.
Okay. So when you say earn yield, that sounds like you're saying you can lend your money. Is that what it is? And so how is that different from, let's say, traditional lending? And is that what DeFi is, the ability to lend?
Yeah, so DeFi is a broader concept. DeFi is basically finance reimagined in a way where not few institutions or few individuals are controlling the most important aspect of the finance. When you think about finance, it starts with the money itself, then it goes into lending and borrowing, exchanges, asset management, insurance, all these payments, all these categories. So you can imagine Bitcoin was the first decentralized application, which was creating the money layer. And then on top of it, you have other layers. So just like in case of India, you have the INR, which is the currency layer. And then on top of it, you have banks, which provide services like lending, borrowing. They provide services like yield accounts, like savings accounts. Then you have exchanges, asset management platforms. So DeFi is basically creating this whole finance in a way which is decentralized, where the control is not in the hands of few people or few institutions.
Okay, so what's particularly bad about some institutions having control, right? I mean, this is people's money we are talking about, and doesn't it help to have some like trusted organizations to be doing this?
Yeah, so whenever you have trusted entities, more often than not, what happens is some people or some institutions might have access to information or resources which not a lot of people do. Because of that, it happens like humans are selfish, and as a result, people start exploiting that information arbitrage or that resource access arbitrage. And because of that, what happens is you get into that instability zone. So I'm sure like a lot of people have heard about this Harshad Mehta scam. So in that, what happened was there was some loophole how you can loan money and where you can put it. And few people had access, few people knew about that loophole. And then few people had access to like get that kind of a capital. And because of that, what happens is like you are continuously exploiting the system. And then that exploit is continuously increasing a lot. and it reaches a point of time where it just becomes unstable, and that's when you see like this financial tumbling, and that's when like systems crashes, you lose a lot of money in that whole thing. So the system reset happens at a much lesser frequency. When you think about DeFi, since information is public, any kind of loophole, so currently you can consider the smart contract risk, which is basically if there is a bug into the contract, into the code. Since the code is public, everyone can see that loophole. And since everyone can see loophole, people start filling it up. So before it gets like a $10 billion hack or like a $100 billion hack, people start filling that gap. And as a result, the system starts getting more stabilized. There are much less loopholes into the system. So that's the benefit like this brings because of the transparency and the equal access.
Okay, you're saying something like the Wikipedia model, where because so many people are monitoring an article, if there's a factual mistake, like people can come in and correct. That's
exactly.
Okay, so that okay, right? That's I understand the security bit, but let's say lending, right? So effectively, you are saying you can create credit within, with DeFi, you are able to create credit. But wasn't the whole point about crypto, etc., was that you cannot sort of create money out of thin air, which effectively what credit is. So help me understand why the crypto community suddenly seems to be okay with that.
Yeah. So see, like when it comes to credit, the problem is like, how do you make sure, first of all, whom you are giving the credit to? So how do you make sure like this person is going to pay back? And how do you make sure that this credit is not going to put the system at risk? So you make sure of that because of the code. Like in the traditional financial system, since all this decision making happening through human, and humans might have self-interest, they might make mistakes. Because of that, there might be bad loans. There might be like large sum of money getting lost because you give money to the wrong people or to the wrong institution. In this case, what you are doing is, first of all, in crypto today, all you have is our collateralized lending. So how it happens is, before that, like, let me bring one more concept called stablecoin. So when Bitcoin and Ethereum got created, the first problem for people were like, all these were volatile assets. People could not use it in daily use cases. And because of that, there was a demand of a currency which was stable in its value. So there came the concept of stable coins, which is basically coins whose price are pegged to dollars when we are talking about dollar-backed coins. And how do you do that? So there was this project called MakerDAO. In that, you basically deposit, let's say, 1 Ether, and assume like today 1 Ether's price is $3,000. So you get back 2,000 coins, 2,000 dice. Now you can always get back 2,000 dice, and everyone can basically assume like this is $1 worth. How you are making sure that now protocol needs to make sure it is always having that much amount of dollar, so that the dollar die value is always attached to the dollar. So how do you do that is, let's say the Ethereum price goes down by 33%. So now the Ethereum you deposited is worth $2,000. If it is going to get lesser than that, then you issued DAI, the value of that DAI will go down because the collateral was $2,000. So you basically sell the Ether a person deposited, and you get back the money. And that's how you are making sure that the number of DAI issued is always equal to the dollar value of the Ethereum inside that smart contract. So it's basically our collateralized loans, and that's how you are making sure. Now it becomes permissionless, because now I don't need to know who you are, how good a person you are, what is your credit history, because what you are doing is our collateralized loan.
Okay, that's interesting. I think I've heard of another stable coin. I think it was called Titan.
It's called Tether.
No, so Tether, I understand. There was another thing called Titan and Iron. There was a pair of currencies.
Okay.
That was also supposed to be a stable coin, right? And it collapsed. What happened there then?
Yeah, so now you can see, like, since this is an open source world, people are going to innovate. People are going to come up with different models. So when you are creating DAI in our collateralized fashion, it is less capital efficient, because you are always putting up 150% of the capital to borrow 100% of the capital. So people are trying to come up with models in which there is higher capital efficiency. So as a result, there are different algorithmic designs. So like whenever we study economics, there is this concept that supply and demand functions. Like if the supply is increasing, then the value is going down. So most often than not, like we only play with the demand when it is about currency, especially like in case of crypto. Like we were always talking about like limited supply, that Bitcoin is this much supply. In case of stable coins, algorithmic stable coins, what people are trying to design is a new system where they say, okay, like if today the demand is going higher, the value of that stable coin is going higher. So whenever the dollar price leaves, let's say now that stable coin price is $1.05, a person can always come and mint based on a dollar from the protocol itself. So there is an arbitrage opportunities. So that's how you are increasing the supply. If you are increasing the supply, the price will come back down to $1. Similarly, if it goes down, people can always sell back it to the protocol. So that's how you are reducing the supply. And that's why you are again bringing the price of that token to $1. So that's how like it is oscillating. Now, in this case, there are different loopholes sometimes. Like how do you make sure if the divergence is like too high? So in this case, like most of the protocols involve another token which represents this whole ecosystem. So you can consider that token plays the role of insurance. So now whenever people are borrowing this stable coin, they are paying some interest rate. And this interest rate is basically directly attached to the value. So the value is getting occurred to people who are holding that protocol token. So Titan was that token basically. So whoever, I think like, I'm not sure if Titan was the stablecoin or stablecoin name was something else, but like it's a two-pair kind of a currency where one token is always pegged to $1 and another one is kind of acting as an insurance. But since like there was no rules, there were like some certain economic, you can say gap in designing this system, the value went down by quite a lot and it couldn't come back. And that's why that system failed. And again, like this is what I meant. If you again come back to the same conversation, there was this loophole. It got filled because it was open source. Everyone could exploit it. And because of that, it was a hack, but I will call it like this gap could have been much bigger in the traditional financial system where information was not public, but here it got filled quickly. And then the next version of stablecoin will be better because they know these are the loopholes we cannot continue.
Okay. All right, fair enough. That sounds like a complicated system, but I have a more simplistic question here. From what you just described, there is actually no real dollars anywhere, right? It's all, you deposited Ethereum, you got Ether, you got another token which was worth $1, etc. Right? So this is all sounds like monopoly money to me, right? It's all paper money. There's no, and then you're talking about earning interest on top of that, etc. How does any of this make sense?
Yeah, so I think the fundamental question is like, if Ethereum is valued something, it is valued something. You can pretty much ask the same question about gold. Like gold is not money, but we can obviously value it in terms of dollar. Similarly, you can always value Ethereum with dollar. Now, if Ethereum you can value, just like gold you can value, you can put gold as collateral. Similarly, you can put Ethereum as collateral. And based on that, you are issuing another asset. Now, this asset is basically making sure that there is minimum collateral which is maintained into the world, and that is providing the security. And if you come back to the point of dollar, like that's how dollar used to issue as well. Like people used to deposit the gold into the reserve bank, and that's how new dollar used to be printed in the traditional financial system, like much before probably 1950s or something like that. So it's basically the same system. It's not like you are creating money out of the thin air. Instead, today we probably do that, where we just think like, okay, today there was COVID and we need to create more money to push it into the economy. That is what I call like creating money out of the thin air.
Okay, that's fair. All right, so let's assume that, okay, so Ether has value and therefore you've got these tokens. So you are making a point about stable coins and how that is an important component of DeFi and loans within crypto. So maybe continue to build on that.
Yeah. So now, like once stablecoin came, imagine like till 2017, the biggest things which were happening in crypto was trading. Like everyone was, but just trading. Nobody was using cryptocurrency for any kind of payment or any kind of things. So now, if you think about it, like the whole point was creating a finance in a decentralized way. But since you were just trading, all of your crypto were actually in a centralized exchange. So if you think about it, like you were just recreating a bank in a different way. Like now, Coinbase was a new, different kind of a bank. And again, that is an institution which is controlled by few people who are the largest stakeholders. There might be interest de-alignments. So like people want to get the maximum value out of a user. Similarly, like there are security risks, like if Coinbase goes down, like people might lose their capital. So people quickly realize like that is the biggest problem we need to solve. We need to come up with a way in which people can exchange assets between each other in a peer-to-peer way, in a trustless way. So with that came the decentralized exchanges, and Uniswap was one of that. And what happens there is, just like here, Coinbase is the one which is acting as a counterparty. In this, there is a smart contract, which is just a line of code, which is acting as a counterparty. So you are sending it one token and it is giving you another token. And just like at an exchange, generally there are market makers who provide liquidity. Here, there are liquidity providers who basically deposit both sides of the tokens into the smart contract. And whenever the trading is happening, these are the people who earn back any trading fees out of this smart contract. So this is how we created the decentralized exchange. And with that, now we are moving towards the derivatives. Now, like till now, this was just spot. Now we are trying to create the same concept using the smart contract. We are trying to create like the futures and the options kind of protocol. Similarly, like insurance became another problem. Like there are new type of risk when you are dealing with smart contracts, which is like there might be bug within the smart contract, just like we imagined the case of Titan, for an example. So people are creating decentralized insurance protocol in which, again, it is written in the code that if this protocol gets hacked, then people can like earn back this much amount from the reserve capital, and then they have to pay premium and all of that. So this creates like different type of yield opportunities. If you think about it, lending, borrowing, you were getting yield from interest. In case of exchange, you are getting yield in terms of trading fees. In case of insurance, you are getting yield from the premiums. So like this is how we are creating the whole finance, where people are the capital provider, and then the community is the action. Community is the one who is writing the code. So code is transparent. You can't change it after once it is written.
Okay. So I'm still a little confused about the difference between, let's say, Coinbase and you said Uniswap.
Uniswap, yeah.
So Uniswap is a piece of code, but somebody wrote that code.
Yeah.
How are they compensated for writing that code?
Yeah. So now whenever you are trying to create a protocol, so imagine like anything you are doing in blockchain, anything you are trying to create peer-to-peer, the basic thing is like there is going to be a network. There are going to be two type of entities. So when you are creating an exchange, the network is like there is going to be a buyer and there is going to be a seller. So in case of an centralized exchange, there is a middle party between these two players. In case of a decentralized exchange, there is no such party. Instead of that, in the previous case, you were representing this value from equity perspective, like whatever revenues you are making, it is ultimately going to the shareholders in some way. Similarly here, now you are representing this whole network with a token. So call it uni token in case of Uniswap. And whenever, like, let's say some tradings are happening, the community can decide that, let's say if you are making $100 worth of revenue, out of that 10% of the revenue will go back to people who holds uni token. And ultimately the uni token plays the role of governance, like how the rules of Uniswap protocol or of this network should be played out. So again, like go back to the point, you are trying to create a network in that the network participants themselves are creating the rule. So it's basically user themselves are creating the rules for each other.
So like a lot of people are writing the code for Uniswap.
So not necessarily, like let's say you write the code and you submit it as a proposal that I think, okay, so let's think for an example, that today Uniswap charges 0.3% fees on every trade. Now some person can come and say like, I think we should do 0.15% trade fee per trade because this will attract a lot of users. So you put this as a proposal, and then whoever holds Uni token, they can vote on it in proportion to the whatever number of tokens they hold. And as soon as like there might be governance rule that as soon as more than 50% of the tokens vote for yes, this passes, and automatically the trading fee changes from 0.3% to 0.15%.
And how do you get this Uni token?
So like again, when you try to create this network, the basic distribution model is, since you are a user, the protocol will distribute tokens to you. So anyone who traded on Uniswap, anyone who provided liquidity on Uniswap, they get proportion of tokens based on like various different rule sets. The rule set could be everyone gets equal amount of token. The rule set could be you get token in proportion to how much trade volume you did. So this is like the initial token drop when you are launching the token. After that, usually the initial token holders, which would be like, let's say in case of Uniswap, I think they distributed tokens to some 20,000 people, 20,000 addresses. Now they can write the rule set how we are going to distribute the rest of the 80% of the tokens. That could be based on, let's say over the 4-year time period, we are going to distribute tokens. In the first year, we will distribute 50% token. In the second year, we will distribute 25% token. In the next year, we'll distribute 10% of the token. And within that, you can apply rule sets like anyone who trades $1,000, we are going to give 1,000 tokens to them. Anyone who trades $10,000, we are going to give 5,000 tokens to them. So again, like there could be multiple permutations and combinations, which is decided by the users themselves.
This is for people who are trading, but to build an organization in some way, like in the traditional company sense, right? There are a lot of people who are employed to do marketing and content writing and all sorts of things, right? They are not necessarily so-called participating in the protocol itself, right? They might be advertising Uniswap somewhere. And since this is decentralized, they could be practically like volunteers.
Yeah.
Then how would you compensate them in where, in a system where, how do you write code to compensate somebody for sending out a tweet on Twitter? For example?
Yeah. So now there are two things which is happening. First of all, let's say if you are a user, if you already hold Uni token, you are financially incentivized to promote about what you hold. Like just like if you will hold Apple token, Apple stock, you are naturally like inclined to say good things about Apple because you want Apple to perform. Similarly, all these users will by default market about the protocol. That's the best like benefit of creating a decentralized product, because your users themselves now become like the promoters at the same time. Now, how to do compensation? Like there might be more complex things. For an example, you need some new design. How do you get that? So in this case, like there is a new concept called DAOs. The full form is Decentralized Autonomous Organization. So how it functions is like, as I again mentioned, like the governance is happening with the people who holds Uni token. Now someone can come and say, hey, we need new design for Uniswap. So they put up a proposal and say that anyone who designed this new design, we are going to distribute 2,000 Uni tokens to that person. Then the rest of the community kind of approves on that and the budget is allocated and anyone can complete that task and earn back that number of tokens.
It sounds like the existing shareholders can decide to issue ESOPs to anybody who's doing something.
Yeah. And again, like it's just one way of saying that. It could be dollars as well. Again, like it could be USDC, which is a stable coin. But more like than not, like anyone who wants to participate within that network, most often than not, like they will want the piece of the network itself. So they will want the token itself instead of like a dollar or a stable coin.
So from the sound of it, there's nothing to prevent us recreating even the standard type of company on the blockchain also, right? Where right now, the thing you're talking about is where it's community and community begins to own more and more of the company. But you could just as well have a protocol that does not give out tokens and just has people come and trade, and you can build a real company on the blockchain. Is that right?
Yeah, you can. So I think the most logical things which should be built in this way are things which requires a network, which requires a lot of people coming together. That could be, for an example, like just an abstract example, this could be ride sharing apps, where there is again a network of drivers and the cab riders. So you can build a better system in which you are removing the middleman and you are bringing the incentive alignments. But let's say if you are creating something like where you do not require a network effect or anything like that, where you do not require two side of entities, most likely it is not going to work. It is going to work because like users, there are different kind of users who are building that network, and you are giving the piece of the network piece, economic piece of that network to these users.
So, which is why decentralized finance, by just by that term, because it is decentralized, lots of people are participating in creating this system. That is why the blockchain is the right way to build a system like that.
Exactly.
All right. So coming back to you talked about over collateralized loans, etc. Give me a concrete example. Let's say I own. What do I do with a loan in the crypto world? If I've got Bitcoin and I'm going to borrow against that, what am I going to borrow and what do I do with that?
Yeah. So I think like today the most used application for borrowing in crypto is trading. So there are people who want to have leverage position. When you want to have leverage position, you need to borrow capital. So just like in traditional finance, you most likely borrow it from the exchange itself or the broker itself, who will then be charging you funding rate. So let's say you have $1,000 worth of capital and you want to open a position which is 2x leveraged. So that basically means you need to borrow $1,000 extra by having this $1,000 as collateral. So now what happens is like, since you have this $1,000 as collateral and you borrowed the extra $2,000, now you can open a position worth of $2,000. Correct. So now let's say you borrowed, you opened a position for Ethereum for $2,000. Now at this moment, your Ethereum is worth $2,000 and your collateral is $1,000. So basically your debt is $2,000, but your collateral is $1,000. So as soon as your position value come down to $1,000, we will automatically liquidate your position. So that basically means, let's say Ethereum goes down by 50%. So your $2,000 position is now worth $1,000. So if it goes down below that, then like the lender is going to lose money. So to save that, like the protocol by automatically like liquidate your position and recover the $1,000 and give it back to the lender.
Okay. Right.
Does that make sense?
It does, but here's the thing, right? So let's say this protocol I brought in, and let's say let's use like the stable coins, right? So I brought $1,000 worth of stable coins.
Yeah.
I deposited that. So that of course is under your control, right? Or the protocol's control. And you've given me $2,000. Presumably I can take those $2,000 outside of the protocol to buy Ether, right? Then how does the protocol know what I did with that $2,000?
Yeah, so you cannot go outside the protocol. So like, let's say somebody is building an leverage trading platform. You are opening the position within that protocol only. So it's not like you are getting the Ether yourself. That's a position which is maintained in a smart contract. Now that smart contract is making sure you can always like sell back, and like, let's say your position is now worth $2,500. You can always sell back, keep $1,500 to yourself and pay back your $1,000 debt position back to the lender. But at the same time, like you cannot take out the whatever Ethereum you got, and take it outside and sell it back.
Okay. So basically it's not, the products then are not like just a pure lending system. It's lending connected with whatever activity that you want to do with the borrowed amount is also sort of packaged into the protocol.
Yeah, so I mean, it depends on use case to use case. So in this case, like you could have done it in other way as well. Let's say you had one Ethereum. So now you deposited one Ethereum, and the value of that one Ethereum was $2,000. So you can borrow 50% worth of that value. So you can borrow $1,000, and then you can again buy back Ethereum from that $1,000. So that basically means the protocol has $2,000 worth of Ethereum, and you have now basically 2 Ethereum plus some more Ethereum you bought from $1,000. So basically 3 Ethereum. And as soon as since you borrowed $1,000 and your 2 Ethereum was with the protocol, as soon as the value goes down, the protocol can sell your Ethereum and can basically get back the dollars. So that position is, so whenever you are depositing the collateral, it is always into a smart contract, and that is always an our collateralized position.
But in this second example, I could actually take out the
so you can take out the dollars.
I could actually take out the dollars and do whatever I want with that.
Exactly. Yeah. But
because you have $2,000 worth of Ether, but if the Ether itself went down and it dropped below the $1,000, you'll just sell it off and recover your loan amount.
Exactly.
All right. So in that case, it's like traditional lending. Then I could do whatever I want with it, and you don't really care about
it. Exactly. And now I think people are building systems in terms of reputation or credit history. So now we are seeing some early experimentation for protocol to protocol lending, because in case of a protocol has a very large reputation. So like Uniswap, for an example, there might be another protocol who is ready to provide capital to the Uniswap, which might be under collateralized or uncollateralized. But in that case, then Uniswap token will be held as the reserve factor.
Okay. I guess humans love to eventually build complex systems, whether it's on the blockchain or not. So that will happen. All right. So just very quickly, what can one expect today to earn if I brought in a US dollar stable coin and I put it into one of the say a decently good protocol? What could I expect to earn in protocols today?
So in a simple lending and borrowing protocol, which is have gone through beta testing, has been around for quite a lot of time, they can earn anywhere from 5 to 10% annual yield. It fluctuates depending on the time horizon, because most of the yields are coming because of trading, and then trading is a function of the market itself. If there is a bullish market, there are going to be more borrowers for the capital. So 5 to 10% is what you can expect. Then what happens is as I mentioned, when you are becoming user of a protocol, that protocol is also giving you tokens, and that token will be worth because you are creating the whole network. Network is meaning something. Network is worth something. So you can consider this as if you are a new protocol, then you are obviously earning the 5% interest, but on top of that, you might earn the protocol token rewards as well. And using that, the yields can go even higher, 80%, 50% sometimes. But in this case, your risk is now higher because now you are dealing with a newer protocol.
Right. So you are earning equity plus, so just to put it in a traditional finance terminology, you are earning an interest component, but you're also getting part of the equity of the business itself.
Exactly.
And that's an optionality. If that becomes valuable, then your yield will look much higher than.
Exactly.
Okay. What other ways are there to earn a yield?
So this was just the lending and borrowing. The other way is, and by the way, even in lending and borrowing, imagine a scenario. So I'll just bring in what Mesh Finance does for an example here. So if you lend your capital to a lending protocol, that lending protocol will be giving you the base interest rate plus their reward tokens, as we spoke. So what happens is you are getting interest depending on how much dollar you have deposited or how much underlying you have deposited. So protocols like Mesh helps you compound that. So you get back that, let's say Aave is the lending protocol. So you are getting Aave tokens plus the base APY. So Mesh automatically liquidates the Aave token, convert it back to the dollar, and then deposit larger amount of dollars. So if you deposited $100, you got $1 worth of Aave token, I will sell it. Now you have $101 and I'll again redeposit. So now you are earning interest on $101 instead of $100. So this is the asset management category, where I am helping you to earn the maximizing the yield. That's what Mesh does. The second way of earning yield is providing liquidity to the decentralized exchanges like Uniswap, for an example. Now, as you can imagine, there are multiple types of tokens, probably thousands of tokens, and people continuously want to exchange between one token to another token. So let's imagine just one scenario where there are multiple types of stable coins, where the price of the token is dollar. So one stable coin is DAI, as we spoke, and then another stable coin is USDC, which is issued by Coinbase. So people might want to convert DAI into USDC or USDC into DAI. So what I'm doing is I'm providing both the assets into this smart contract, and then anyone can come exchange their tokens, and then they are paying the trading fees. So I am basically earning the trading fees on the tokens I have provided. So that is like another way of earning yields. You can imagine like this is democratizing the market making itself.
So basically, understood. There is like a huge variety of new things actually. So this is not even something that is sort of generally available in traditional finance.
Exactly.
All right.
In traditional finance, this will be done by an institution. I'll actually give you a right example. Like in case of Robinhood, for an example, there will be few institutions whom Robinhood will be selling its data. Then that institution will be using that data to provide liquidity to the Robinhood. So they will put buy order and sell order. They'll put both side of orders and will earn between the arbitrage between buy and sell price. Here, like since everything is public, it can happen with anyone. Like as a retail user, you can also tap into those opportunities.
Yeah. As long as you have, that you're willing to take whatever risk is involved, then
yeah.
So why will regulators allow this at all, right? So just think about the fact that, regulators and all these trusted third parties, in the real world, these are big vested interests. And even the regulator would not want to lose control over all these mechanisms, especially, because money is important. So what happens to all of this if and when they crack down?
Yeah, so I'm not even sure if I'm the right person to answer this. So I'm just going to express my views, which has nothing to do with like what I actually think about legal systems and all of that. I definitely think in this case, regulators are going to fight as much as they can, because simply they are losing power from the monetary system in this case. And we are, in fact, already seeing this in US, in China, and all these geographies. Especially like in China, it's much harsher compared to US, which is more of a democracy kind of a geography. So it ultimately comes down to people. I personally believe like governance is about people. We have created these institutions to make ourselves govern, like which is about hundreds of millions of people governed. If we can create better system of governing ourselves, like where we don't need to give power to 10 few people, instead like as a collective society, we can govern ourselves. I think that's where we are going in the future. That is going to be the future of governance. So government is just an institution. It's the governance which we need to solve. And I think these are better ways to solve for governance. So I personally believe this is eventuality. There will be some hurdles on the way. Some governments are going to fight it much harshly. Some governments are going to fight it a little less harshly, but every government is probably going to fight it a lot. And if you think about government, even governments, like even in government, probably top 50 people have the highest level of power, but that is not the government institution. In government institution, there are tens of thousands of employees. And there are no incentive alignments. Like most of the government employees earn way less than they should earn probably. And that's what leads to corruption and all these problems. So probably like we are going to solve all these problems with the power of people, with the wisdom of crowd.
But one way that, in some ways, so one is to, the governments fight back and stop the system or try to stop the system. The other is to co-opt it, right?
Yeah.
Which is what, so there are like, I think I read a report somewhere, there's like 80 or 90 different central banks right now that are actually planning to sort of bring out at various stages of bringing out their CBDCs or central bank digital currencies. Right? Lots of different structures are being planned. What do you think happens? How do they fit into the ecosystem? What do you think happens once they become a dominant or an important part of this system? What happens?
Yeah, so I think it is going to coexist till a certain point of time. See, it is not about just the digital currency. It is about the values, how the currency is getting created. Even if you issue a CBDC, that's just a digital currency. But even if in that, only 10 people can say like how much new currency is going to get printed tomorrow, then it is not solving the problem. it is solving the problem in the sense that the money is getting digitized, but it is not solving the problem in terms of like how it is impacting the society. So depending on like how CBDCs are created, they will coexist or they will lose value with time. Like the currency which will have the most product market fit will be which is in the best interest for the most number of people. Ultimately, like that's where humanity will thrive. And like just like because you mentioned this number, like many countries are looking for CBDC. So like El Salvador was the first country to adopt Bitcoin as a currency. Why is that? Because there are not more than 20 countries who have stable financial economy. Like probably India is what is India's rank in terms of inflation rate? I'm not sure, but probably it will be still in the top 10. We still have the stable economy. But if you start going out in the bottom 80 countries, like the inflation rates are so high that it doesn't even make sense to hold your own currency. So for those kind of people, they are not going to look for dollar or some currency which is issued by another government or another country. They are going to look for a currency which is more decentralized, which is more neutral. And that's where I think that the power will come. Like El Salvador, I think was the first one. We will see more and more such countries joining this bandwagon where like these currencies are better for them compared to like dollar, which were issued by some other country at all.
I think this is an open, I think CBDCs, I think even central banks don't really understand. So it would be hard to answer this question very definitively. In any case, I think we are closing in on the hour. So I would like to hear what you think about, where we are in the DeFi movement today and what are some of the near-term interesting things that we are likely to see. So in the long run, like you were saying, we would probably get rid of central banks and etc. That's like a utopian dream or something. But in the short run, what do you think are some of the more interesting projects being built and what's happening in the DeFi space? We'll talk about that.
Yeah, so I think like the best way to think about it is finance is the backbone for humanity. Like it enables the coordination system. So finance itself has to be neutral if we want to build a better coordinated system between humans. So the more base layer you go into, the more decentralized it needs to be. As a result, Ethereum needs to be decentralized. Bitcoin needs to be decentralized. As you start going up into the stack, so there comes this application layer, which is like exchanges, lending, borrowing. They might not be as decentralized as the currency itself. And then there might be the whole fintech spectrum. So like today, if you are trying to build something which might help a lot of users dealing with finance in much better way compared to today, in the traditional finance system, like you might have to go for multiple entities to ask for permissions and all of that. This is a permissionless system. Imagine like just like how hundreds of thousands of game developers can design games, hundreds of thousands of developers will be able to build fintech applications because the base layer is open source, base layer is open to everyone. And with that, we will see a lot of innovation, like on the application layer, just because like everything is open, everything is public. So now we are probably entering into a zone where we will see a very different trend within the fintech space. There might be applications solving for, let's say, trade finance, for an example, where the invoices could be collateral, and then you can borrow money from anyone in the world using stable coins. You are basically removing all physical boundaries. You are removing all permissioned boundaries. And you are still able to make systems which are stable, which can reset itself, like which doesn't fail because it is written in the code. There obviously might be different kind of bugs, but again, as I said, that is going to be the cost of experimentation.
It's almost easy to say cost of experimentation, but as these DeFi applications, the on-ramp is becoming easier. The reason for people who don't really understand the technology, who don't understand even basic hygiene in terms of, let's say, password protection, etc., as they are joining this whole movement, let's call it a movement, right? I mean, there are so many horror stories about people who have their MetaMask wallets emptied because they clicked approve on some shady website, etc. Right now, obviously, even in a regular banking system, people get conned all the time with OTPs, etc. But there is at least some appeal to authority. There is some hope that something can be fixed. How do you see, as this movement spreads, from the nerds, let's call them, and the geeks and the people who are building this and who understand the nitty-gritty, to the more ordinary people who are just in it to effectively park their life savings to protect against inflation. What is the community doing to protect those people against this kind of loss?
Yeah, so I think like it's a multi-phased problems. So the first level of problem is the user interfaces themselves. As you mentioned, like using MetaMask is very challenging. And it's not like using MetaMask is challenging, it's like understanding MetaMask is more challenging, like the strings, the private keys, etc. So there are multiple developments happening in that, where you are trying to make the user interface much simpler, probably even simpler than the traditional financial applications like your probably Google Pay or Paytm or all these applications. We are going to get better in user experience compared to even traditional finance applications. There is no doubt people are going to go through this much complexity. In terms of like reducing scams, like bringing quality projects in front of the users, I think now we are thinking about reputation systems where people can quickly see like, okay, if I'm going to interact with this project has this level of reputation. So I'm going to only interact with protocols which have reputation greater than 8 or something like that. And all of these systems are going to create by the community itself, instead of like by one person who can say like, Moody can basically decide that this particular company is rated AAA versus this company is rated BB. Instead of that, here the whole community is going to decide like this one is in this spectrum, you might lose, you might make up this much. And that's how like the whole thing will go down. So it's information making simpler and the user experience getting simpler at the same time.
I'm going to push back a little on this users saying whether some protocol is good or bad. If Amazon product reviews are anything to go by, right? Or even IMDb movie reviews are anything to go by. I don't think we have a great record of ascribing reputation properly. Right? But in the case of a movie or a restaurant on Zomato, right, the downside is limited in the sense that you've wasted 3 hours watching a stupid movie, or you maybe had some bad food. The stakes here are much higher, right? So why will it be different? Why will the experience be different in this case? Why will people be able to rank things better here than Zomato or Amazon?
So let me just give you one example, because I don't know how the future will evolve. But let me just try to give it by one example. So in case of like Amazon reviews, first of all, you don't know who is writing the reviews. There is no rating of the person himself who is giving the review. Second, there is no incentive, like there is incentive disalignment, like the person who is writing the review, either, so if you actually go through Amazon reviews, like most of the reviews will be either like the 1 star, or most of the reviews will be 5 star. Like there will be very few reviews between the two. So the 5-star ones are given by the seller himself because he wants to sell the product, and the 1 star are given by the competitors because he wants that this guy doesn't sell the product. So there is no cost of putting the review, and there are different incentives for doing that. In case of blockchain, now imagine like you have a resume because your whole wallet history is public. I can see like for how long you hold a particular token. For an example, let's say you got Uni token as a reward. Now you might be a person who is just selling the Uni token the next day, or you might be a person who is holding that Uni token for a year. So I can clearly say that you have better interest in Uni than the first person. Now, if you are writing the review, I'll give much better review weightage to your review compared to the next one. So basically, we will build all this system because like the information is public. There is identity, and identities are earned. It's not like you can just quickly create another identity. It is getting accumulated with time, with the whole data, which is non-changeable, like which is immutable. That's the power of immutability. And these things will come into effect because like probably we had 10,000 users just 2 years back. Now we have 10 million users who are using MetaMask. So now this whole information is getting assembled together, and now we can build up all these systems. And I think that there will be much better ways. Like this is just one example. I can clearly say that there might be better systems in which we can say who is real, who is in saying something in the good interest for the society or not.
You said something very interesting about identity being earned rather than just created out of thin air. That's a very interesting concept. I think it probably is also going to end up having some connections with the whole NFT space.
Exactly.
Which I think we will need another episode to talk about NFTs, and I'm hoping we'll be able to catch you and bring you back for that one. But I think this is all the time we have for today. Thank you so much for putting up with very, very adversarial questions. I think I prodded you and poked you a lot, but thank you for your patience. And I think our audience will have gotten some better sense, at least more respect for the DeFi scheme, because I can tell you that a lot of my listeners are people who are very, very skeptical. So hopefully they'll have a greater understanding and greater respect for this field. And if there are any more questions, I'm going to get back to you. And listeners, if you have any questions, please feel free to write to me. Drop a comment on this video, and we'll get Rohit to answer that maybe in the next episode. So thanks, Rohit. Thanks a lot for your time.
Thanks for having me, Parijat.
Bye-bye.